cash flow statement versus income statement in 5 minutes. In 3, 2, 1, go. Cash flow is the amount of money getting in and out of the business. Income statement can show the revenue and the expenses of the business and tells how much money the business has earned or lost, or more known as profit or loss. Sounds same, right? If the money is not received yet by the business, then the cash flow statement will not record it unless they have their money in their businessy hands. Both cash flow methods need 3 things. First is operating, which is all the money made from the sales minus tax, minus salaries, minus cost of goods, transportation, and many more. Second is investing. Moving on. These are the things that you should buy for the business to make the place better. And no, John, you buying a $4 Wiggly Aloha figurine for your desk does not mean it's investing in the business. Lastly is financing. If I get this wrong, this is your fault. Money like taking a loan from the bank or investing in other businesses should fall in this category. If you take money from the bank, your financing is positive, but probably by next month, you'll have to pay it back, so it turns negative. Now you know the basics. Here's how to make the statement.
Whoa, that's pretty long.
That's what she said.
Operating on the top, investing in the middle, and financing on the bottom. And conclusion, bottom. Operating does all subtracting in its parts, and if you end up with a negative number, boy, your business dead. In investing, it's normal for it to be negative since you're buying stuff for the business. But if it's positive, equipment you sell it. For financing, it's normal for it to be either positive or negative. It depends if you're borrowing money from the bank
just to buy a Rolex.
The last is the conclusion, or what I just call it conclusion, but it's actually movement in the balance sheet. You basically minus the amount of the cash from last year, which we shall call now the start of the new year and the end of the new year. If the end of the year is bigger than the number that you've made, then you've made money. Now, what's that for exactly? Well, the amount of the calculation of the balance sheet lines up with the calculation of the 3 others combined together. Then you got it correct. Add the sum of operating, financing, and investing together, and if it matches with the sum of the movement in the balance sheet, then pat yourself in the back, buddy, because good job, you did it. Now, there are 2 different methods. The first one that I just showed is called the direct method. Now, the other one is called the indirect method, which changes only the operating into 3 tinier sections, and I don't want to talk about that. I forgot to mention that tiny thing on the top that you see right there, right? Like that tiny thing right there? That's called net profit. Well, you need to get that from the income statement, so basically you can't make the cash flow statement without having the net profit that comes from the income statement and the cash that you have from the start of the year and the end of the year that comes from the balance sheet.
Minus points for cash flow statement.
Now, the income statement is much less of a hassle than cash flow statement, but no pinky promise, not even Elmo can. It's simple. You just have 2 things, revenues and expenses. Revenues are the things like sales, and that's really it. There are also things which they call less, which is not an expense, but it decreases the sales because they include discounts and product defects. So yeah, your problem. Expenses include cost of goods sold, salaries expense, utilities, transportation expense, depreciation. You get the point, it's a lot. Now, let's see the statement. Oh wow, that's much simpler than cash flow. This one is called single step, and it's pretty easy. Take the revenue and subtract it to the less, then subtract it to the expenses combined. If you have positive money, then you have profit, and if loss, if negative. Then, put the number at the top of the cash flow statement, which is the net profit. Now, you may be asking, why am I showing a picture of a crab?
I don't know, it just looks cute, and my teacher says I have to make this video look fun.
The second method is called the multi-step. Now let's take my example from the single step here to the multi-step. Whoa, that's a lot of difference. Remember operating from cash flow statement? Yeah, we're gonna bring it here real quick. I told you what operating means, so I'm not gonna say it again. So we're going to put everything that's operating under here. Then we're going to add up all the operating expenses and then minus it with the gross profit. There can be other sections in multi-steps such as other revenues, gains, and other expenses and lesses. Even if you had all these steps anyway, you would still come out with the same results when you use the single step anyway, so I'd rather use single step. Summary: plus points for income statement because it's much simpler to understand and it's much easier to do. Minus points for cash flow statement since it needs the income statement and the balance sheet in order to be made. Which one do you need? You need all 3. I don't know why, but you just need all 3, and I don't want to explain why because I do not actually know. That concludes everything.